All right, well, let's discuss the global backdrop and the road ahead for India with Geoffrey Dennis, independent emerging markets commentator. Mr. Dennis, great to have you on. Good morning to you. So now we're getting some sense of partial relief, some hope that there's going to be a rollback in those tariffs, and there's still some room for negotiations. That's given global equities a sigh of relief. But what do you think lies ahead? And specifically, I mean, if you talk about a market like India, which has been reeling under these FPI outflows, how is the overall backdrop looking?
Well, I wish I knew, frankly, because, of course, the situation with tariffs is extraordinarily volatile. And we enter this week, and there's a lot more aggressive tariff action apparently coming with respect to China, with respect to Canada and Mexico and China. Now we're getting some relief apparently on that for a month on the automakers. It just goes round and round in circles. And I think this is really, really bad news, actually, for the US economy, which maybe we can talk about in a minute. And this is what's been driving bond yields lower. Now, if you look at where we stand here, is I think Trump is still obsessed with the idea that he wants to put tariffs on many countries and many products. And so I don't think in any sense we're going to get major relief from here, except we just don't know. Now, how does India stack up with all of this, as you've asked me that? Well, my call this year has not gone well. I thought India would perform better than it's done. China, of course, is led the way for a number of reasons, not least perception of undervaluation, perception of decent growth. 5%, of course, is the new government's forecast, etc. And, of course, the new AI tool coming out of China. But at the end of the day, I still think money will come out of China, go back to India, because the India story remains, I think, better long term. And now you've seen a tremendous move in relative valuations between the two. Now, as all of this goes on, China is a target of Trump and tariffs. India, I don't think is. It could become one, but it's not at this point. The growth story is much better. And of course, you mentioned a few moments ago, there's been a very sharp drop in oil prices in recent days, and that's very good for India as well. So I'm sticking to my medium-term bullish view on India.
Geoffrey, a dollar has also come off very sharply. That's positive for EM flows. I mean, 3% in 3 days, the broader dollar. And of course, oil is there. And so things seem to be constructive here. At least the backdrop is quite constructive. Just a quick view on what we saw in Europe, Geoffrey. It's a big sea change. I mean, I don't want to exaggerate, but it almost looks like Europe is going to start to rearm itself. I mean, of course, they're going to spend on other stuff, roads and bridges and energy plants, etc., but also defense. And this is a change after, I think this is a seminal change post-World War II.
I think it's very, very important, and I think you've hit the nail on the head here. There are two things driving the dollar lower. First of all, the US economic data is terrible, frankly, and there is an increased risk of recession. Let's leave that aside for now. What's going on in Europe is very, very important, particularly in Germany, setting aside money for increased infrastructure spending, for increased defense spending, and in particular, an agreement between the CDU and the SPD in Germany to essentially ease the debt brake, so-called, the limit on how big the debt increase could be. That is very, very, very important because, of course, Germany for so long was the sort of anchor of Europe, the example of fiscal rectitude, inflationary control. And now they've thrown a lot of money at this, which I think they need to do. And I think it's been also very interesting how politically so many people in Europe have rallied around Ukraine since this extraordinary argument between Zelensky and Trump and Vance in the White House less than a week ago. So now you're talking about more defense spending, countries cooperating, France, the UK, Germany, and you're talking about security guarantees. This is a very, very big change. And I think this has played a tremendously important role in driving the euro higher as well. But don't forget, the real signs of weak US growth are playing a role also.
All right. Hi, Jeff. Good morning. Good to see you. And Jeff, since we're talking about Trump, what do you think the bigger focus for him is going to be? You know, when he won the election for the second term, everyone thought Trump's going to be good for equity markets, particularly the US markets out there. Now he's in a bit of a cash-22 situation, right? Trump's or the markets? What do you think is going to be his bigger focus?
Well, the word over here is that what he's going to focus on now is bond yields because they're falling. And when Scott Bessent, the new Treasury Secretary, talks about we're going to get interest rates down, apparently now everybody is told we should be focusing on long rates coming down, not short rates. The Fed is in no position right now to be able to reduce interest rates unless this economic data gets a lot weaker. I think it's very interesting that with the equity market being so soft so far this year, the US market is in negative territory now for the year. Trump just doesn't talk about it, which I think is interesting. But I think we may be close to a little bit of a breaking point here in the sense that the economy is very soft. I don't know if you've seen this.
Yes.
I'm sure you have. The
Yes.
Atlanta Fed forecast for Q1 is minus 2.5%. That's a bad sign. And also, of course, the sheer uncertainty over tariffs is terrible for consumer confidence, terrible for business confidence, terrible for investor confidence. So I think he's saddled himself now with a very soft equity environment. Globally, okay, things are looking better, helped by the lower dollar. But frankly, the US equity outlook right now doesn't look good because of all the mistakes he's making and all the volatility that he's creating with his tariff policy.
Now, one would only hope that perhaps, he listens, because he did yesterday. He held that call with US automakers. He called up the Ford CEO, and that's how some of the rollbacks on the components happened, or some partial sort of relief that kind of came about. And Nigel, you were saying something.
So, Dennis, Trump's tariffs will be more a negotiating tool, is what we're getting to. Do you think that's going to be the way it plays out?
It seems to be the case, although some of the things he would indicate suggest that it's more than just a negotiating tool. And I don't think net, when we look back in a year's time, we'll find that tariffs are lower or the same. They're going to be higher. We just don't know by how much. And he's going to look for deals to possibly take them off for a period of time, put them back. Right. The problem with tariffs is that they raise inflation. This economy can't really deal right now with higher inflation. The Fed would not be able to reduce rates. And I think it's this dilemma, maybe a hint of stagflation, that is really pulling the US equity market down and the dollar down. And frankly, Trump policies are really pretty awful for the equity market in the US right now. And we've got to see if that's going to change.
Okay, all right. I think there was some acknowledgement yesterday in that speech, State of the Union, that near term we should bear some pain. And I thought that was interesting. Thank you very much, Geoffrey. It's always great to speak with you. We'll take a quick commercial break here. Lots of stock-specific action. Our research team joins in with exactly that in just a bit. Top 10 segment coming up.